Mahesh Nandurkar joins us, strategist with CLSA India. Mahesh, fantastic to have you back and thank you for joining us. Mahesh, the easy answer to why markets are going higher is liquidity. But is that the only reason why markets are going higher?
Well, yes, I mean, clearly, it's a question of demand supply. The global liquidity situation is quite supportive and, much more so in India. However, having said that, we clearly have to see that, India is still, by the way, not the best performing market regionally, or in the overall, in the emerging markets. So all the markets are going up. India is going up as well. But yes, in case of India, the flow dynamics are slightly different, where it is driven more by the local sort of investors, which appears to be more sticky. But aside from that, I would say, one other way of looking at valuations, while like clearly they are significantly higher than what we have been used to seeing historically. But my clear argument here is that those higher multiples are based on low cycle corporate earnings. So, what I mean by that is, the current level of profitability measure by, whether you measure it by way of ROEs or by EBITDA margins, is clearly at a significantly lower level as compared to what the averages are. So, we are currently witnessing low cycle earnings, and to that extent, I would say that the high cycle multiples that the market seems to be giving, on that doesn't seem to be sort of completely out of the whack.
Mahesh, so I'm just going to spend one more minute trying to understand the flow picture. And broadly, if you look at the month of July, the FI activity was not very constructive, and DI activity was strong. But if I look at the profile of stocks which have gone up in the recent past, in last 2 or 3 weeks, it's HDFC Bank, Reliance Industries, Bajaj Finance. Now, these are stocks which are typically dominated by foreign institutional investors. I mean, the Indian fund managers, they typically don't like to buy HDFC Bank or HDFC Limited, and they never chase Reliance. So, what explains this kind of an price action dichotomy? If foreigners are not buying and domestic institutional investors historically have not bought some of these mega caps, who's buying into them and why are they going higher?
See, my sense is that the domestic institutional investors, have also turned somewhat more cautious, and I think in terms of the allocation, I think probably greater amount of money is going into large caps, than mid caps or small caps, and we've also seen the cautious stance by the domestic sort of investors, partially is also visible in the high proportion of cash which a lot of funds sort of seem to be carrying. So yeah, so I would say some of the large cap stocks have been going up, more more on the back of that. And I would say that this is a healthy thing. Some of the large cap names, be it on the financial side, housing financial side to be sort of more precise, also the corporate banking side, appear to be not that highly valued vis-a-vis history. So there is some sense of valuation support in some of these names.
Right. As we speak, Mahesh, in a while, but we've seen the market dip below 10,000. Not that that would change, view on the market or make investors concerned at all, because at 9,900 odd as well, we are in a zone of our own. But what is the perspective that you have from a valuation standpoint? I know the comparisons being drawn time and time again, and the market is split between the believers and the naysayers about where valuations stand versus market levels. Okay,
so see, valuations are clearly on the higher side, but where which segments of the market appear to be more attractively valued on a relative basis, and where we see much better potential over the longer run, is the stocks where we think the profitability, as I mentioned before, is at a significantly lower level than what we have been used to seeing, as measured by way of ROE. So I think what we have seen in general is that over the last 5 to 7 years, the capex cycle activity in India and the housing construction activity in India has been significantly weaker, and our firm belief is that we are at a cyclical low. there are some very early signs of cyclical recovery, which are slowly begin to be visible. Those are, the capacity utilization rates begin to rise across the board slowly. We kind of have also noted, on this channel earlier as well, that the housing affordability is looking like it has come to the best levels that we have seen in the last 2 decades. And no, I'm not referring to the central Mumbai or the central Delhi properties, but more like in the middle income or the the affordable side. So these two factors makes us believe that we are at a cyclical low and the bounce back is imminent. So therefore we should be focusing on stocks which can actually take advantage of the cyclical upturn, and which were also the stocks which were partially negatively impacted over the last 5 to 7 years because of the downturn. And as I said, some of the sectors that look attractive from that parameter is corporate banks, housing finance, metals, steel is one sector that we quite like. Then you could look at capital goods, some of the discretionary size on the food services business. So these are some of the segments where we think that the earnings growth outlook over the next 3 to 5 years can be very strong, and those are some of the sectors or the stocks that is what we are recommending.
You made life very easy for television anchors because you've pretty much mentioned all your preferences. So I'm struggling hard now to think of my next question. We can't talk stocks, but I have a lot of follow-up questions on the themes which you mentioned. You talked about HFCs, but
sure,
looking at the numbers which we've got from Repro, and that's not yardstick of what lies ahead, are you getting a sense that HFC growth is going to be slightly unpredictable? Tanveer and me were discussing this point in the morning, that the HFC business has now got hyper competitive. I mean, there is no moat around it. Everybody and anybody wants to be in that business. So whereas the headline growth is great, but at individual companies, do you think companies would struggle?
Okay, so let me give you some perspective on this. So one might argue that the housing finance business or the mortgage book or the industry has grown reasonably well even in the last 5 years. So what's the question, and how does one fit in the cyclical low argument over there? See, the thing is, if I give you some numbers, the housing construction market over the last 6 years or so has remained flat with a value of around 7 trillion rupees or 7 lakh crores. The total amount of housing transactions that were financed last year was still 5 trillion rupees or 5 lakh crore, which means that 70% of all the housing transactions in India were financed, 30% were not. This number was 45% financed and 55% not financed by the organized sector 5 years back. So the entire growth that we've seen in the housing finance space over the last 5 years has been driven more by improved penetration. Such as, if one was not borrowing to buy a house, he is now borrowing, or maybe borrowing, earlier from the unorganized market now into the organized market. The loan to value ratios have gone up, or, the average tenor has gone up. But the housing construction market has remained flat for the last 5 years. And what we are suggesting is now we feel that the underlying market will begin to grow. So therefore we feel that the mortgage industry growth will be in the range of 15 to 20%, I would say, over the next at least 5 to 7 years. And when the industry growth is going to be as strong as what we are projecting, I would not care too much about market share losses by one player or the other. And I don't want to comment about specific stocks, but I definitely say that the industry outlook is very attractive, and also given the fact that the builder financing market, which was also not growing over the last few years, which is actually a higher margin business, so for the companies who are catering into that segment, we feel that that would also help in sustaining and improving margins.
Mark the selling year, Mahesh. 10% off for JP Associates, 6% off for Unitech, Syntex down 5%, Suzlon down 3%, Himachal Futuristic down 2.5%. Now this is the real reality if you ask me. When prices go higher we cheer, but when they correct, and when stock prices, at least some of these high debt, stroke or leverage and momentum names, when they reverse, they will hit you. And again, a polite reminder, I think we've been indicating again and again that if you want to play momentum, please understand the definition of momentum. It is not everyone's cup of tea. Not every real estate company will survive. Not every high leverage company will be able to take advantage of the reversal in cycle. If I actually look at the current setup, if there are 100 companies which are currently suffering with debt, I think only 5% of them will revive and survive. Those 5% will be bigger and larger. I understand that, and they could be multi-bagger in making. But just because the JP Associates has cleaned up and they are in the process of cleaning up, every company is not going to follow the same path. Some of the companies don't have assets, Tanveer. I mean, even if they want to genuinely clean up, who's going to be bailing them out? I mean, JP Associates had some assets. They had cement plants which they had set up, and the cycle for cement has turned. So, it's helping them, but not every company will revive and survive. So, Mahesh, what if a client calls up and says, look, Mahesh, I want to take a slightly high risk bet on India. I am happy to digest a 15% volatility, a 10-12% upside, but I want high risk and absolute return ideas. So, what could be the color of that portfolio? I mean, if you have to really give a advice to an hedge fund. I mean, typically hedge funds, they look for high risk, high return ideas.
No, so I've already mentioned some of the stocks. I mean, not the stocks, but some of the sectors that we like. So my advice is pretty consistent. So I would still say some of the same names. Whether on the financial side, whether on the metal side, I still feel that one should be buying into those names. And as you mentioned, there will be some volatile times. So I think those would be the opportune moments in my view.
India VIX has also gone up by about 8.5%. This is the first time I think the bears are feeling happy, but I don't think.
I wanted to ask Mahesh, did he advise clients to start selling, Mahesh?
Mahesh, but in general, I mean, are you getting a sense that the best of the gains for this calendar year are behind us? Because we are up 20% already this year. So do you think a lot of the earnings surprise and a lot of the gains for this calendar year and financial year have been front-ended?
Oh yeah, I would say so. I mean, the markets are up about 25% in the first 6 months. I mean, you can't expect to see a similar return in the next 6 months, or I would say even in the next 12 months. So my base case, here is that the multiple should more or less sustain. And we are looking at the earnings growth in the range of around say 12%, 12 to 14% or so. So my base case and my expectation for the market returns over the next 12 months is in low double digits. I would say maybe like 10 to 12%, something like that. And that should make the investors happy, because we have to readjust to the fact that we are now in an environment where the CPI inflation is in between 4 to 5%. The 10-year bond yields at about 6.5%. So the expected return on equities cannot be like 18 or 20%. So I would say 10 to 12% is what the investors should expect, and that is what I think we will likely get over the next 12 months.
Okay, so Mahesh, where does IT and pharma fit in? I mean, are these companies likely to see not a price-wise correction, but a very long time-wise correction, and we should kiss goodbye to even single-digit returns for next 1 year?
I think on the pharma side, at some point in time, the structural story will re-emerge. Currently there are several headwinds that the sector has been facing, be it the price erosion, in the US market, or the regulatory, or sort of some of the actions by the US FDA, etc. So at some point in time, things will stabilize and the value will emerge. But we feel that it's a little too early to look at that as a scenario, but we are keeping a very close track of things there, because some of the stock prices have corrected quite meaningfully. But yeah, so whether I would jump into those names just as yet, actually not, but I would definitely be keeping an eye on that, and maybe sometime in the next 6 months or so we will get some sort of indicators that things are bottoming out. So not just as yet. On the IT side, I would say that we have to kind of adjust to the fact now that the industry has gone into a significantly lower growth outlook for a reasonably long period of time. we should not be expecting double-digit growth, in the sector. Maybe 6 to 8% is what the new normal, is looking like, and also coupled with that, the fact that the rupee also seems to be, quite strong. The lot of underlying drivers for that, seems to suggest that we are not likely to see, a big depreciation in the currency that we have seen, over the last sort of 3 to 5 year period. So keeping that in mind, I would say that the IT sector has definitely become a low growth sector. Yes, there is definitely a possibility of some valuation related bounce back that could happen over there, but it's not a sector that I would buy and hold with a 3-year or a 5-year view. So one could sort of take a tactical call on it, that the market is overheated and maybe there could be some pullback, and so IT will probably perform better, etc. But it is going to be a tactical call and not something that I would buy and hold for next 3 to 5 years. As against that, as I said, in case of pharma, that 3 to 5 year call will come at some point in time, maybe in the next 6 months, but not just as yet.
Okay, Mahesh, before we let you go, primarily, focusing on the way the market has come off, and I know you don't give near-term calls, but the way we've come off from 10,000, just wanted to ask you about, what could have triggered this selling? Is it just valuation-based profit taking at higher levels, you think, and that can hit the market on any given day, a reason or no reason? Or do you believe that this has to do, with a bit of a sentiment rub-off on account of that SEBI circular calling 331 companies shell companies, and that just clouds the market about the quality, especially in the mid-cap space, of companies that are trading, and the rally that we've seen in some of them?
No, true. So as a combination of high valuations and what we've seen today in terms of the SEBI taking action, I think there is clearly some merit in what you just said. So I would clearly say that from the sort of medium term or the long term sort of point of view, the investors still have to be sure that they are investing in right quality of the management, and I think what has happened today probably just reiterates the fact that one needs to invest in good quality businesses and good quality companies. Maybe one can give some leverage here and there on valuations, but not on the quality of the business and the company.
Well, Nikunjan, so just before, perhaps this could be your closing comment. This is not the sort of correction, and I would call it a correction, and barely so actually. I would really call it a blip and an adjustment in price action. But this is not the starting of what you would say a meaningful correction that the market has been calling for just as yet. And you wouldn't read much into it. You wouldn't be concerned by this fall that we are seeing right now.
Yeah, I mean, the market could correct. I mean, we have seen the market moving in just one direction for the last so many months. So there can always be some pullback. But I wouldn't really, get unnecessarily alarmed, by this pullback. I would say that this is a buy on dips kind of a market.
Appreciate your time. Thank you for joining us.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.